Welcome back to the deep dive. I don't know about you, but if you were watching the charts yesterday, I almost had a heart attack.
It was ugly.
Monday looked like the absolute end of the world. Black Monday, everyone is panic selling, the timelines are just on fire. And then Tuesday morning hits, and suddenly we're in one of the biggest pivots I've seen in years. What on earth happened in that 24-hour window?
It really was a tale of two markets.
Yeah.
You had this liquidity fracture, basically the plumbing burst coming out of Asia.
Right.
That dragged Bitcoin all the way down to nearly, 74.8? It looked like total capitulation.
It did.
But then, just as fast, the selling just vanished. And we entered this phase of what we are calling aggressive institutional absorption.
Absorption is a very polite way of saying the big players started eating everyone's lunch.
Pretty much. While retail investors were just frozen, staring at the red candles, institutions stepped in to buy the fear.
So why? Why catch a falling knife when everyone else is just screaming zero?
Because the floor was basically reconstructed overnight. We have like four things happen almost simultaneously.
Right.
A massive trade realignment between the U.S. and India, a total reversal in the South Korean stock market, the ETS turned back on, and miners started making these huge infrastructure moves.
All right, let's start with Korea, because that feels like where the bleeding started, right? Monday was a complete disaster over there.
It was. The KOSPI, that's their benchmark index, it tanked over 5%. Absolute panic.
Wow.
But Tuesday morning, they actually triggered something called a buy-side sidecar.
I've heard of sidecars, but usually when things are crashing, not going up.
Right. It's a circuit breaker.
Yeah.
Usually they use it to stop a crash, but this time they used it because the market was ripping up too fast. The index surged almost 7%.
To a new all-time high.
To a new all-time high.
That's manic. What changed their minds so fast?
Chips. Specifically AI chips. Samsung Electronics posted its biggest gain in 17 years, up over 11%.
17 years.
Yeah. Basically, the market got confirmation on shipments for the new HBM4 chips and just realized, oh, wait, the AI trade isn't dead.
Okay, so good for Samsung. But I'm still struggling to see the connection here. Why does a rally in Korean electronics stop Bitcoin from crashing?
That's the fascinating part. It's all about leverage. You see, South Korean retail traders are huge in crypto, and they're also huge in stocks. When their stocks tanked on Monday, they got margin called.
So the broker calls them up and says, give me cash or I sell your positions.
Exactly. And if your stocks are tanking and you can't sell them fast enough, what do? You smash the sell button on the only thing that trades 247 and is super liquid.
Your Bitcoin?
Your Bitcoin.
So it wasn't that they hated Bitcoin, it was just the only ATM open on a Sunday night.
Precisely. It was mechanical selling. A forced liquidation cascade. As soon as Samsung rallied, the margin pressure just lifted. The forced selling stopped.
And the price could breathe again.
And the price could breathe. We expect the kimchi premium, that extra price Koreans pay, to start to normalize now.
So the panic selling dries up in Seoul. But while that was happening, you mentioned a trade deal, something between Washington and India.
This is the macro heavy hitter. While everyone was glued to the charts, President Trump and Prime Minister Modi finalized a deal on February 2nd that effectively resets the global risk map.
I saw the headlines, U.S. slashing tariffs on Indian goods. But what's the real story there?
The real story is energy. India agreed to stop purchasing Russian oil. And get this, committed to buying $500 billion worth of U.S. energy.
$500 billion.
LNG, coal, the works.
Wait, pause there. If the U.S. is selling that much energy, doesn't that make the dollar stronger? And usually, a strong dollar, it pushes Bitcoin down. So why did the market treat this as good news?
That is the million-dollar question. And normally, yes, a spiking DXY, the dollar index, it hurts crypto.
Right.
But here, the uncertainty factor was just bigger. The threat of a trade war has been this dark cloud hanging over everything. By signing this, the market basically exhaled and said, okay, the trade war is off.
So it's a risk-on signal?
Exactly. The relief from removing that massive geopolitical risk was powerful enough to just override the currency correlation. Investors looked at the stability this brings and just decided it was time to buy assets, even with a strong dollar.
So the geopolitical temperature drops, the forced selling stops, and I guess that sets the table for the big money to come back in?
The ETFs.
The numbers for February 2nd are just wild.
They tell the whole story. I mean, we had 4 straight days of money leaving the funds, just bleeding out. Then boom, $561 million in net inflows. in a single day.
So that erased the entire previous week's negativity in just one session.
One shot.
$500 million. Who is writing those checks? Because it really doesn't feel like the average guy on Twitter is buying it.
Definitely not retail. No. Retail is likely still shaken from Monday. Look at who led the pack. Fidelity took in over $153 million.
That screams financial advisors.
It does. These are people allocating for 5-year horizons, not 5-minute charts. But the real signal, the one that really caught my eye, was BlackRock.
I bet.
They took in $142 million. But here's the kicker. That inflow happened while the fund's average investor was briefly underwater.
Meaning what exactly?
It means smart money was adding to their position at the exact moment the average holder was losing money. That is high conviction. They weren't just buying the dip, they were buying the valuation.
So everyone else is running for the exits, and BlackRock is just standing at the door with a bucket catching everything.
They saw the math. They look at metrics like the MVRVZ score, which hit record lows, or the RSI, the Relative Strength Index, which dipped into the 20 to 25 range.
Which just means oversold.
Severely oversold. Historically, every time the RSI hits that low since last August, we get a minimum 10% price bounce. The algorithm saw the number and they just hit buy.
They bought that valuation floor between, what, 75 and 78,000?
That's the one.
Okay, so that covers the financial side. The money came back. But while the traders were trading, the builders were actually doing something pretty interesting, too.
The build layer. Yeah, this is the stuff that often gets ignored when price is this volatile.
We have news from TeraWulf. While everyone was panicking about price, they were out shopping for power plants.
They were. TeraWulf announced a major expansion strategy, acquiring what we call brownfield sites to add 1.5 gigawatts of capacity.
Okay, brownfield. I hear that term a lot in real estate. Break that down for us. Why does that matter for Bitcoin mining?
So think of it like moving a restaurant into a closed-down Pizza Hut versus building a whole new building on an empty lot.
The plumbing is already there?
Exactly.
Yeah.
The plumbing, the gas, the high-voltage transmission lines, the substations, it's all there. TeraWulf bought a former aluminum site in Kentucky and an old generating station in Maryland.
So they can move in way faster.
So much faster. If you try to build that grid connection from scratch, a greenfield project, you're waiting years just for permits. By buying these used industrial shells, they can plug in miners almost immediately.
And 1.5 gigawatts is no joke. They're making a very long-term bet here.
It creates what we call a hash rate floor. These large industrial miners like TeraWulf are lowering their average production costs by securing cheap, stable power at scale. It makes them much more resilient.
Right. They aren't going to turn off their machines just because Bitcoin drops 5%. They're digging a moat.
That's a good way to put it.
Speaking of moats, Tether made a move that sounded a bit tech-heavy but seems really important. They launched something called Mining OS.
This is a direct shot at the centralized control of mining hardware. On February 2nd, Tether open-sourced this whole operating system.
Okay, explain the problem first. When I buy a mining rig, an ASIC, doesn't it just work?
It works, but it runs on firmware that's provided by the manufacturer.
Yeah.
And historically, that firmware has been a total black box. You can't see the code.
So you don't really know what it's doing.
Right. There have always been fears about backdoors, hidden fees, maybe even a kill switch, where the manufacturer could just turn off machines remotely. It's a huge vulnerability.
And Tether's new OS changes that.
Completely. First, it's hardware agnostic, so it works on any machine. You aren't locked into one vendor. But the really cool part is the hole punch technology.
Hole punch.
Imagine if your mining rig could talk directly to other rigs peer-to-peer without having to check in with a boss server at headquarters first.
So it removes the central point of failure.
That's it. It removes the central command server.
Yeah.
So if the internet goes weird or a company goes bust, the miners just keep on running. It makes the whole network harder to kill.
It's fascinating how much is happening under the hood while we're all just staring at the price. But we can't ignore the government layer. We were staring down the barrel of a shutdown this past weekend.
We were, but that bullet has been dodged. The fiscal cliff is resolved, at least for now. The House passed H.R. 7148 with a huge majority, 341 to 88.
But there's always a but with these things. I heard Homeland Security is still on the hook.
There's always a little drama.
Yeah.
Yeah, the bill funds most of the government through the fiscal year, but it put DHS on a short-term continuing resolution. They bought themselves about 10 more days to argue about immigration reform.
But for the markets, the important thing is that the rest of the government is open.
That's what matters.
Why does Bitcoin care if the Department of Labor is open?
Data.
Yeah.
Pure and simple. Those institutional algorithms buying the ETFs, They run on data. They need inflation reports, labor statistics, jobs numbers. If the government shuts down, those websites go dark.
A data stream cuts off.
And when the data cuts off, the algorithms get scared because they can't model risk. When they can't model risk, they stop buying. By keeping the government open, the data keeps flowing, and the Wall Street models stay happy.
So the lights stay on in D.C., but there was another meeting in Washington that didn't go quite as smoothly, the stablecoin summit at the White House.
Yeah, this is a heavyweight bout. You have the banking lobby, the ABA on one side, and then crypto heavyweights like Coinbase and Circle on the other, and the whole thing is deadlocked over one word: yield.
Interest.
Right. The banks are absolutely terrified. Their argument is if a stablecoin issuer like Circle is allowed to pass the interest from their reserves on to the user.
So if I hold USDC, I could get paid like 5% just for holding it.
Exactly. And if that happens, why would you keep your money in a traditional checking account that pays you 0.01%?
Yeah, you wouldn't.
The banks estimate that by 2028, this could drain $500 billion from traditional bank deposits.
That is a massive number. I can see why they're sweating. It's an existential threat to their cheap funding.
It is. But the crypto side has a strong argument, too. They're saying, look, this is about global competitiveness. If U.S. regulated stablecoins can't pay yield, capital will just move to offshore companies that do pay yield.
So do we want the money in New York or in the Bahamas?
Or precisely. They're framing it as a national security issue, to keep that dollar-denominated capital onshore.
Did they figure it out?
No. Total deadlock. And the clock is ticking. The White House set a hard deadline for the end of February. If they can't find a compromise by then, the Clarity Act, the legislation for this whole space, is likely dead for this session.
So we have a regulatory clock ticking, but there is another date on the calendar that everyone seems to be whispering about.
Sure.
March 31st, 2026, the return of the FTX money.
This is the delayed stimulus that I think the market is completely underestimating. Everyone just forgot about it. But on February 2nd, the FTX estate confirmed they are freeing up cash.
They reduced their disputed claims reserve by over $2 billion.
And confirmed the payout date, March 31st.
How much money are we talking about here?
In this specific wave, $9.6 billion.
Nearly $10 billion. And this isn't going to random people, right? This is going to a very specific group.
That's the key. This isn't a government stimulus check. This is $9.6 billion hitting the bank accounts of people who had money on FTX. By definition, these are crypto natives, traders, DeGans, early adopters.
People who know exactly how to use an exchange.
And people who have a historically high reinvestment rate. When a crypto trader gets a windfall, they don't usually go buy bonds.
They buy crypto.
They buy crypto. So late March, you have almost $10 billion of liquidity getting injected right back into the hands of the people most likely to use it.
Now, combine that with what we were just talking about. The ETFs are just vacuuming up supply, $500 million a day on Tuesday alone.
Supply's getting locked up.
And then on March 31st, you drop a $9.6 billion demand bomb on a market with shrinking supply.
You can see the squeeze coming.
It creates a powder keg dynamic. The market successfully fleshed out all that shadow leverage, the weak hands during that Monday panic.
Right.
The pivot we saw was structural. Coins moved from nervous retail traders to confident institutions, and now we have a massive liquidity injection scheduled.
It's all lining up.
So for the listener watching the charts this week, trying to figure out if this rally is real, what are the key levels to watch?
Technically, keep your eye on the CME gap. There's a gap in the futures market between roughly 77.4 and 84.4. Markets hate gaps. They almost always try to fill them.
And what's the trigger?
$80,000. If Bitcoin can reclaim $80,000 and turn it into support, make it a fortress, then we likely see a rapid move to close that gap toward 85K.
And if we dip again?
The floor has been pretty clearly painted by that ETF buying, that $75,000 to $78,000 zone. That is where BlackRock and Fidelity stepped in. So unless the world actually ends, that area should act as very strong concrete.
It has been a whirlwind 48 hours. From panic selling and margin calls to record highs in Korea, trade deals, massive inflows. It just goes to show how quickly the narrative changes in this space.
It does. And I'll leave you with this thought. We get obsessed with the red and green candles. But look at the plumbing. We have trade deals stabilizing energy, miners securing gigawatts of power in old factories, and bankruptcy estates preparing to flood the zone with cash. The spring isn't broken, it's being coiled.
A $9.6 billion stimulus check for crypto traders, hitting a market where supply is already scarce. That is definitely something to mull over. We will be tracking that February deadline for the stablecoin bill closely, so make sure you stay tuned.
It's going to be an interesting month.
Thanks for diving in with us. We'll catch you on the next one.